Hello, I'm Chris Flood, Chief Correspondent at ETF Stream. I'm at ETF Ecosystem Unwrapped, the largest ETF conference in Europe. And I'm speaking to Matthew Tagliani, who is the head of ETF product for Europe at Invesco, the world's fourth largest ETF provider. Welcome, Matthew.
Thank you very much.
I hope you're enjoying the conference.
It's been fantastic, so appreciate it.
So tell us a little bit about what your role involves, please, Matthew.
Sure. So at Invesco, my role as head of ETF product is really sort of twofold. At a high level, it's about defining the overall commercial strategy of our ETF range, again, across client types and the sort of rather heterogeneous demand that we see across Europe, which has, again, different parts of the continent have greater or lesser degrees of ETF demand from different client groups. So that kind of managing that overall from a sort of a product perspective, and sort of more concretely, it's really about I manage two teams of ETF strategists and content. And what their responsibilities are is they're basically the subject matter experts on our product range. So they're there to support our distribution colleagues. That is, whether that's with technical content, insights, but it's also about sort of the ongoing messaging and the content that supports that the ETF sales team eventually use with our clients.
So before we started the interview, we were talking a little bit about commodity markets. I mean, no one can have failed to have noticed the increase in the crude oil price that has occurred since the beginning of the Iran war, but there's also been some other very interesting moves in commodity markets. Earlier this year, gold hitting an all-time high, silver rocketing to an all-time high as well. And so you were saying that you're seeing more interest in commodities from your clients.
Absolutely. I think we think that commodities are really one of the big sort of long-term secular trends that investors need to pay attention to. And the reason for that is, firstly, it's always been an area, it's always been an asset class that we've been very focused on. In Europe right now, there's about $250 billion in commodity-linked products. Invesco manages about 37 billion, so about 15% of that. I think we're known for both. We have one of the largest gold products in Europe. We also have the largest broad commodity product. So it's always been an area that we've focused on, but it's sometimes been a little bit more difficult to convince end clients of where it fit in their portfolio. What was the value add, as it were? And I think the last few years have really shown a spotlight on what that value add really is. And the reason for that is what we've seen is equity and fixed income prices moving up and down together. So and that positive correlation means that the traditional sort of 60-40 to, as a simplified example, that traditional 60-40 portfolio no longer provides the diversification benefits that I think people have historically come to assume. So we think that for investors looking for sort of diversifying assets, something to add to their portfolio, with commodities have a lot of value there. And the reason for that is there's a few things that they're sort of historically they've been known for. Everyone thinks of gold as a safe haven asset. People think of it as a hedge against inflation. Similarly, when you look at broad commodities, it's a hedge for inflation because a lot of the sort of the raw ingredients of production are incorporated in broad commodity indices. So there's an inflation link there. But what's kind of been the most exciting aspect, in the last few years, has been just how salient, broad commodities sensitivity to geopolitical tensions has become, and that's really. Whereas most products, when things go bad, markets go down. And as we've seen in the last couple of years, commodities are kind of the opposite to that. Whether it is supply disruptions, impacting the price of crude oil, whether it's just general geopolitical tensions, whether it's, any of these multiplicitous factors, which they're the same factors which affect the rest of your portfolio, but very often with commodities, they affect them in a different direction.
Mm-hmm. And what types of clients are expressing an interest in?
So that's actually the ETF industry in Europe it started off in its sort of core of private bank and asset managers, and you sort of thought of it as a barbell from the sort of lowest end of investor sophistication, sort of retail, basic level retail investors, all the way up to sovereign wealth. And distribution started off a bit like a bell curve, less over here, quite a lot in the middle. And both of those wings have really been coming up. I think specifically with regards to commodities, there's still a lot of opportunity for growth in that sort of core client base. Retail clients, we think, are also ones who have there's a lot for them to benefit from this. The sort of sovereign level, I think the sovereign wealth funds, that sort of large institutions, I think they already have, in many cases, more specific direct ways that they access commodities. But in this kind of evolving demand of everything from the basic investor through to relatively sophisticated asset managers, we view our role as kind of twofold. It's one part of it is delivering products that do reliably and efficiently what they're supposed to, and that's always been kind of the core. But what's kind of been the shift in more recent years is there's a lot more focus just on education, because as much as you can convince people at a high level, this is a great product for your portfolio, it has great diversifying properties, it is still a little bit of a mysterious space for a lot of investors. And there's a lot of, for those who are sophisticated and understand the nuances of commodity markets, you can talk about the shape of the futures curve, you can talk about the El Nino effect, you can find the Strait of Hormuz on a map, which many of us couldn't until fairly recently. Those nuances, I think, can make some people feel a little bit insecure about that allocation in their portfolio. So we view a big part of our role is really just making sure that people understand what are the benefits of commodities, and then without going into the nuances of contangos and backwardations and these things, which frighten away a lot of investors, fundamentally is saying, these are the main drivers within the commodity complex. Here's how they're affecting that allocation in your portfolio, with the goal of just trying to keep that sort of long-term, 5% allocation to commodities in the portfolios of investors, because we think it really just provides a lot of benefit.
So you think 5% is an appropriate sort of level?
It's
ballpark?
Where I think people have traditionally, and it's the number people have bantered about. You can do, there's analyses you can do which can show that even a significantly higher allocation can have good diversification benefits. I think to try to tell someone to put 15% of their portfolios in commodities is probably coming on a bit too strong. I think it's dip your toe in the water. And we're seeing the same, the same conversations are coming up with all of the other kind of diversifying questions. Is it, the general category of liquid alts, infrastructure, REIT, all of these things that clients are looking for as diversifying assets that have a different sensitivity to the same drivers that affect all of their other asset investments. I think commodities is sort of the first step in the door, as it were.
So tell me a bit more about this broad commodities product that you have. It's investing across the whole spectrum,
Yes.
Energy, metals,
Exactly. So
agriculture.
the BCOM, the Bloomberg Broad Commodity Index, is kind of the market standard in terms of one of the most broadly recognized. There's a few others out there that are also very well known, but I think BCOM is very often it's the one that we track, and it covers the oil, it covers precious metals, it covers sort of base materials, iron ore, things like this, and it also covers agricultural commodities. And each of those component parts have a material component in terms of the driver of returns. And so you will see that what's going on in gold, which might have to do with central bank gold positioning, then oil, which might have to do with stresses in the Strait of Hormuz. Then you have El Nino affecting agricultural commodities, and they can move around in different directions. And but overall, part of the beauty of it is that diversity of exposures. And I think what we're looking at in terms of going forward is there are also other commodities which aren't included in this space, but which are becoming increasingly important vis-a-vis electric cars and electric vehicles. And the growth of some of those lithium, cobalt, some of these more smaller commodity markets, right now they're still not in the broad commodity aggregates because they do need to be sufficiently liquid, and we want to ensure that the product meets those criteria. But we're looking at how can we also, from the product development standpoint, what can we do to start kind of dipping our toe into the water and incorporating in a small capacity some of these other products. So that's kind of where from a development perspective, because broad commodity indices have been around for a while, they're very well known. Where we're looking going towards the future is how do you kind of interlink some of these other commodities which are becoming increasingly relevant as kind of societal demand changes.
Could you tell me a little bit about creation and redemptions? I mean, if you've got big institutional clients, then obviously creations and redemptions don't work in the same way as they would with a conventional equity ETF, where they can deliver stocks, receive stocks. So this is an important difference if you're
Exactly.
an institutional investor.
So for the broad commodity indices, one of the key, at present, without rounding off the edges too much, all ETF products in Europe are either debt instruments, like the gold products, that's just, again, it doesn't work under UCITS, or they are UCITS funds. UCITS funds are not allowed to have direct exposure to commodities. So all of the commodity-based products in Europe will, in one form or another, leverage the swap counterparties, the banks that can trade these commodities, And the key there is that they deliver the exposure to the fund, but they insulate the fund from one of the sort of key criteria of a UCITS, which is that it can never be exposed to physical delivery of a commodity. It's just part of the regulation. So the reality is that it's an interesting point that you raised, because synthetic ETFs has been a big talking point. We've seen a lot of growth in that space. It's been kind of, Invesco, and then back from our roots as Source, has been one of our kind of calling cards since the inception of the platform. And it was always spoken about in slightly cautious terms by some competitors, less so now when you look at it in equities. It's always been the only option in commodities. And so our platform was built and has always done both. And I think the mechanics of it mirror the mechanics of what you see on synthetic equity, which is the banks are in the end the ones who actually trade the underlying commodities. And the interaction with the fund is very much kind of on a derivative basis. With commodities, with equities, we do that where we see a specific benefit. With commodities, it is the only option in terms of direct route. And then gold, silver, platinum, palladium, those products which we have, again, that's a debt vehicle, which is really just a 1-for-1. You put gold in, you get some certificates out, you give the certificates back, we'll give you the gold to the limited community of authorized participants there.
Well, thank you. That's a really clear explanation. Thank you very much, Matthew.
It's been a pleasure. Thanks.